What happens when two companies become one? It's not just a change in branding, it's a profound financial transformation. Today, we're going to demystify this process by exploring IFRS 3, business combinations. This is the standard that tells us how to account for a merger or acquisition, ensuring the new combined entity presents a clear and accurate financial picture. IFRS 3 requires all business combinations to be accounted for using the acquisition method. This is the core principle of the standard. It involves identifying an acquirer, determining the acquisition date, and then recognizing and measuring the assets and liabilities of the acquired company. This method replaces the previous pooling of interests approach, which simply combined the book values of the entities. The acquisition method focuses on the transaction itself, recognizing the fair value of what was acquired and the consideration paid. The acquisition method is a four-step process. Identify the acquirer. This is the entity that obtains control of the acquiree. Control is the power to govern the financial and operating policies of an entity to obtain benefits from its activities. Determine the acquisition date. This is the date the acquirer obtains control of the acquiree. It's a crucial date because it is when all the measurement and recognition take place. Recognize and measure identifiable assets and liabilities. At the acquisition date, you must recognize and measure the identifiable assets acquired and liabilities assumed at their fair values. This is a critical point. It's not about book value, it's about what they are worth in the market on that specific day. Recognize and measure goodwill or a gain from a bargain purchase. This is the final and often most important step. When a business combination happens, the acquirer must recognize the assets acquired and liabilities assumed. But not everything makes the cut. To be recognized, an item must first meet the definition of an asset or a liability as per the conceptual framework for financial reporting. This means it must be a present economic resource or a present obligation arising from past events. Second, the item must be reliably measurable at its fair value. If it meets both criteria, it's recognized on the balance sheet. This can sometimes lead to the recognition of assets or liabilities that the acquiree didn't have on its own books, like an acquiree's internally developed brand name or customer relationships, if their fair value can be measured. A key exception to this is a contingent liability. Even if its fair value cannot be reliably measured, it is still recognized if it is a present obligation arising from a past event. This is where the true value of the combination is captured. Goodwill is the premium paid over the fair value of the net identifiable assets. It is calculated as goodwill equals consideration transferred plus non-controlling interest plus previously held equity interest, net identifiable assets acquired. It represents future economic benefits from assets that are not individually identifiable, like brand reputation, strong customer relationships, or a skilled workforce. Goodwill is not amortized but is tested for impairment annually. A gain from a bargain purchase occurs when the fair value of the net identifiable assets acquired is greater than the total consideration paid. This is a rare event, and it is immediately recognized in profit or loss on the acquisition date. Sometimes, it's impossible to get perfect fair value measurements on the acquisition date. IFRS 3 gives the acquirer up to a 12-month measurement period to finalize the accounting for the combination. During this time, the acquirer can recognize provisional amounts and make retrospective adjustments as needed. After this period, any adjustments are recognized in profit or loss, not retrospectively. While the fair value principle is the rule, there are a few important exceptions where specific IFRS standards apply. For instance, deferred tax assets and liabilities are not measured at fair value but are accounted for according to IAS 12. Similarly, share-based payments and leases are measured and recognized using their respective standards, IFRS 2 and IFRS 16. This ensures consistency and proper accounting for these complex items. IFRS 3 requires extensive disclosures to provide transparency for stakeholders. The acquirer must disclose the name and a description of the acquired entity, the acquisition date and the percentage of ownership acquired, the fair value of the consideration transferred, a qualitative description of the factors that make up the goodwill recognized, a reconciliation of goodwill from the start to the end of the reporting period. These disclosures help users of the financial statements understand the nature and financial impact of the business combination. So, what does all of this look like on the balance sheet? IFRS 3 has a significant impact on an acquirer's financial statements. First, the most visible change is the recognition of goodwill and other acquired intangible assets like brands or customer lists. These are not typically on the acquiree's books but are now recognized at their fair value, often creating a large asset. Second, the acquirer's cash and other assets used for the transaction will decrease, and any new liabilities from the combination will be added. You'll also see an increase in equity for the amount of consideration transferred. Finally, in the income statement, you will see the effects of the business combination on profit or loss from the acquisition date forward. For example, revenue and expenses from the acquiree will be consolidated, providing a comprehensive view of the new combined entity. In summary, IFRS 3 mandates a rigorous approach to accounting for business combinations. It requires the use of the acquisition method, with a strong emphasis on fair value measurement. It provides a clear framework for recognizing goodwill and includes a 12-month measurement period for finalizing the accounting. This standard is crucial for providing a true and fair view of a company's financial position after a significant transaction. Thank you for watching.